And I said, I'm from finance field. I can really nail it.
Yeah.
In 6 months, I lost 50 lakhs.
Wow.
Gajendra Kothari is the Managing Director and Chief Executive Officer at Etica Wealth Private Limited. Gajendra has built a personal portfolio valued around 50 crores.
I'm gunning for a number called 100 crores. So started with 10,000. Today it is...
What's a safe portfolio if you could break it down in terms
So
of
suppose
allocation?
you want to buy a car in a year's time. So I would say invest in a debt fund.
How much percent?
There were few funds in my portfolio. For 10 years, I made zero return. Whatever corpus I have created so far in the last 15 years, 1% is due to intelligence, 99% is due to temperament.
99%?
99%.
Gajendra, everyone when they think of mutual funds thinks that it's going to be a long-term story. I need to compound my wealth. But now when we're looking at the data, it tells us otherwise. I think nearly 97% of people actually withdraw their money from a mutual fund within 5 years. Why is there such a divergence?
Thanks, Avan. Thanks for having me on the show. So I really love the title of the show, Temperament. So everything has to do with temperament, this 97% figure. But let's take a step back and understand why this figure is so overwhelmingly at 97%, which is as close as 100%, right?
Yeah.
See, money, if you go back 1,000 years, 2,000 years, 1% of the people in the world were rich. 100 years back, 1% of the people in the world were rich. Today also, 1% of the people in the world are rich. Even 100 years from now, 1 or 2% in the world, people in the world will be rich or ultra rich. There is a reason behind it. Money is very emotional topic. Okay, earning money is a different thing, and managing it is even far more difficult. So there was a book written 100 years back, The Richest Man in Babylon. Okay, it was written 1924 or something by an author called George Clason, and he just narrates 7 principles of creating wealth or how to be the richest person in town. And if you read that book, Aman, it's so simple, it's so intuitive and logical. But then why, we are still talking about 97% people are not rich, right? Because managing money or creating wealth looks simple, but simple is not easy. Okay, that's the first thing. Second, like you and money, as I said, is a very emotional topic. While we may all think we are all rational human beings, we all take rational decisions, right? But when it comes to investing, right, when it comes to managing it, we are not rational. We are emotional. We become emotional. Just remember in COVID, March 2020, when markets were 40% down. In hindsight, that was the best time to invest. But people were very fearful. People thought, no, I'm seeing my money 100 has become 70. It might go to 50 or it might become worthless. So let me pull out everything and put in my savings bank account, right? But that was the best time to invest. So we always try to invest when markets are at the top because we feel this is going to continue forever.
Absolutely. And just let's start with sort of mutual fund 101, if it were. Because here you are entrusting your money to an expert. You are not doing your daily sort of homework. Of course, you have done enough about the mutual fund, but not when it comes to individual stocks. So that is a good way to go about investing. But what would be the checklist that investors need to go through before deciding which mutual funds they should put their money?
Yeah. So as you rightly mentioned, mutual funds are far more, organized and professional, vehicles. In the sense, even if you forget, even if you would have picked the wrong mutual fund, because it's professionally managed and because it's a diversified set of basket, it's very unlikely that you're going to ever see permanent loss of capital. Okay, you might say dip in your portfolio. It might go down by 20-30%. Just go back to 2008. Suppose if you would have invested your money in any mutual fund and you would have forgotten about it and you invested right at the peak. But if you wake up after 15 years, you still made 10, 12, 13% return. But imagine if you would have invested in direct stocks, which were the darlings of 2007-8 era, which were like infrastructure stocks. Your portfolio has been wiped out completely. So at least one saving grace is that by investing in any mutual fund, because you own a diversified set of portfolio, you are still better off, right? But having said that, there are few guardrails you have to understand and follow. So the best thing is that there's no point just going and buying a mutual fund based on the immediate past returns. This is the biggest mistake world over people do.
What is immediate past in terms of a time frame? Not looking at 1 years and 3 years.
Precisely.
That's too little.
In fact, now not even 1 year, people are now checking 6 months returns.
Yeah.
Right? And they decide their actions based on 6 months, 1 year, 3 year. Generally, I say look over the returns of a mutual fund over a cycle, which is 5 to 7 years. Look at the track record for as long as possible, 15 years, and see how the fund manager has behaved when the markets were going up and markets were going down. See, you don't want to be investing in the mutual fund which was number one, right? And now, it is, you don't want to be investing in a fund which has been very volatile. I would rather be in a second quartile fund, but this fund has remained second quartile for decades. I'll be far more comfortable.
Okay.
So that's the first thing. Don't chase returns, right? Second, I would say in stock market, in mutual funds or capital markets, if you don't know who you are, capital markets is the most expensive place to find out, right?
Yeah.
Look, you are my colleague. You have made 25% return. If I just want to, if I envy you and I say, look, she has made 25%, I also have to make. But, I am not that kind of person. I can't take risk.
Yeah.
But because I'm just following you, copying you, that's the biggest mistake I'm doing. I have to know who am I? What is my risk-taking capacity? How much drawdown I can see before it gives me sleepless nights. I've seen a lot of people saving for 1 year, 2 year, investing in full equity, small caps, thinking that in 1 year, even if I make 20% return, it's bad. But 3 years, forget small caps. You shouldn't be in equity funds in the first place, right? Because 3 years is right there.
Yeah.
Right? You can't afford to take risk with this money.
Yeah.
Right? So you have to understand what are your goals.
Yeah.
Time frame, short term, medium term, long term. Short term is anywhere from today to 3 years. Medium term is 3 to 5. And long term is 5 years plus. That is the first thing. Why you are saving this money? For what purpose? Then secondly, what is your risk tolerance? You have to, glide up. Right? See, when you go to a theme park, do you go to the most scary ride right in the beginning? No. We just want to warm up, see how are the different rides, and then we gradually up our risk.
Yeah.
But in stock markets, people grow from one extreme to another extreme.
Yeah. And I think a big factor of that would be sort of that FOMO factor. You read those big headlines. I made X lakhs rupees. I made 36 lakhs investing in this in just 1 month.
Okay.
And that just sounds so tempting for someone, right? Especially these young people, the disposable income is increasing. Do you suppose that that is a big reason also that we are seeing nearly a third or almost half of the inflows into equity mutual funds, into these thematic funds and sectoral funds?
It is.
And is that a risky proposition? Is that informed investing according to you, or is that speculative?
No, that's purely speculative.
Yeah.
See, Jeff Bezos once asked Warren Buffett that, your life, you are the richest person, investor on earth, and your book is all open. It's transparent. People know what are your holdings.
Yeah.
But why there's no second Warren Buffett? So his answer was because everybody wants to get rich fast.
Yeah.
Nobody wants to become, rich slower. So F&O, or when you see that I made 25 lakhs in a single day or in a single month, these kind of headlines, on social media, Twitter, wherever, people think, and the way they share these, it looks so easy.
Yeah.
Right? And then you think, okay, I can also do it. This is the biggest mistake we make, because as I said, if you don't know who you are, stock market is the most expensive place. Because you didn't know, you didn't have risk tolerance, you just copied that without knowing the risk, you messed it up. So what I'm trying to say is that creating wealth is not simple, in the sense it will take time. The first thing you have to understand is you are running a marathon, not a sprint, right? There are people who may have become rich, like Rakesh Jhunjhunwala or whatever, by trading, but you are not Rakesh Jhunjhunwala.
Yeah.
He had that genetic lottery wherein he was right. He got right in his early days. And then he also said that, look, I have now shifted from trading to investing, long-term investing. But you can't just copy that. Because he was successful, I'll be successful. So you have to understand that. Secondly, as I said, you need to have a plan. Without plan, if you are investing money just to get the highest returns, that's the worst strategy in creating wealth. You can't be greedy. When we meet a lot of investors, we ask them, what kind of returns do you expect? He says the maximum return, 18-20% return. But they don't want to take any risk.
Yeah.
So risk and returns goes hand in hand.
Yeah.
Right? There is no product in the world which can give you the maximum returns with the lowest risk. If anyone is trying to sell you that, right, it's a lie. Just run away from there.
Absolutely. And I think that to a great extent, even the numbers just say it all in the kind of population that we live in. Amigo, 5 crore investors, if I've got the number correct, are actually investors in mutual funds.
Yes.
Why is that?
That's completely because of lack of financial literacy in our country. Okay. As I said, these things are not taught in our schools, colleges,
Yeah.
workplace. See, I've always believed wealth can never be created by borrowed knowledge. You have to invest your time and efforts in learning, money lessons, right? So if you have to understand how wealth creation happens, you have to either, take these kind of sessions or read books, and you will still make mistakes. You will still make mistakes. That's okay. One thing I want to share, that if you make mistakes early in your career, that's far better.
Yeah.
So I'll tell you my instance. One in 2008-9, I tried to become rich quicker. I was in London that point of time, earning fat salary, and I thought, let me just punt on F&Os, which the figure which you said. And I said, I'm from finance field. I can really nail it.
Yeah.
I lost in 6 months. I lost 50 lakhs.
Wow.
2008-9, I'm talking about. I was 26, 27 then.
Yeah.
Because I was earning a lot of money, I got overconfident about my skills, and I lost. That time, it was the end of the world for me. I lost all my savings, right? Fast forward 15 years later. In hindsight, today, I believe that was the smallest tuition fee that I paid to the markets.
Yeah. Big learning.
Big learning right at the onset of my career. Had I would have done this mistake now, today, on such a large corpus, I don't think I would have been able to bounce back.
Start over
again,
Yeah.
right? So everybody has to pay a tuition fee. I always wish and pray that you pay this fee early in your life,
Yeah.
so that you don't end up awarding, big things, right?
But it seems like people will pay this tuition fee early on, because now headlines are indicating that Gen Z are just putting their money into the stock markets left, right, and center. It's almost like a gambling field.
Correct.
So what is the advice you have for these young first-time investors who are dabbling directly in the stock markets?
Simple advice, that make 2 portfolios, core and satellite.
Okay.
Core is a long-term portfolio where 70% of your savings is for long-term goals, serious money.
Yeah.
30% is your play money.
So I'm okay to lose that money.
You should.
Yeah.
See, if I try and tell you, no, don't do 30%, also put 100% in this thing, we all have itch, right? At 25, 26, you have an itch that let me try this.
Yeah.
And I'm stopping you, which is not a good idea. So you should try with 25% of your capital, whether you do gambling, go to casino, do cryptos, I don't care.
Okay.
You are not answerable on this money.
Yeah.
But the 70% money, do it in the right way. If you have the time and knowledge, you can do it yourself. But if you don't have any one of the two, go to a professional.
Yeah.
Right? Because with this serious money, you can't afford to go wrong.
Yeah, you can't afford to.
Right? So go to a professional, seek his or her advice, have goals, have a plan in place, and then invest accordingly.
And you have built a successful corpus as well over the past many years, of course. It's not been easy and it's not been quick either. How much of your success would you attribute, would you say, to choosing the right funds and being disciplined? And how much would you attribute to having the right mindset or the right behavior?
Beautiful, wonderful question. So I say whatever corpus I have created so far in the last 15 years, 1% is due to intelligence, 99% is due to temperament.
99%?
99%. See, I've created this wealth. So I'm investing all my money in mutual funds. I don't dabble in stocks, no future options, nothing. Secondly, I have this tunnel vision that I have to create this much corpus through mutual funds, through discipline SIPs. The only good thing which I did was that keep on doing the SIPs. Started with 10,000 SIP in 2010. So started with 10,000. The only good thing which I did over the last 15 years is kept on increasing my SIPs. So 10,000 per month became 50,000, 1 lakh, 2 lakh, 5 lakh. Today it has reached an insane number of monthly SIP. I don't really want to share because, many people will think, I can't do this.
Yeah.
And look, you don't have to do this. You don't have to do the kind of SIPs which I'm doing because I'm gunning for a number called 100 crores. 99% of the people who would be watching this don't need 100 crores in their lifetime, right? If you're able to create 4 crore, 5 crore, 10 crore corpus in your lifetime, that's a huge, massive corpus, which can help you achieve all your goals. And for that, you need to just do 50,000 SIP or a lakh SIP per month, which is not very difficult, right? but you have to keep on doing the SIP until you hit the goal. You have to keep increasing the SIP.
Yeah.
And there's a beautiful thing called step-up SIP in mutual funds, right? Just like every year your income goes up, every year your expenses goes up, why not every year your savings goes up? But I've seen a lot of people who have been doing 15 or 20,000 SIP for years, and they never bother to increase their investments. They are very happy with the overall portfolio returns,
Yeah.
but they've never increased it.
Yeah.
And that is where step-up SIP helps. So you have to be disciplined with your money, and secondly, have loads of patience.
Yeah. And so, if someone wants to create that corpus of 5 crores, say, do we start with lump sum investing or SIP? And if you can just explain how one should go about that, because now even the initial amount that you can put in an SIP is ever so meager.
$500.
Yeah.
So even I would say student,
Yeah.
who is 18, 19 can start an SIP. First timer who is into the job can start with $2,000, $5,000.
Yeah.
Okay. But I want to suggest that start today.
Yeah.
Okay. No matter which fund you're choosing, start today. At least you will see the moment you have your first money at stake, you'll become more serious. So start early, invest regularly. As I said, if you can do 1,000, 2,000, 5,000, do it. Then don't interrupt the SIP. See, you said 97% of the people, even in mutual funds, don't create wealth. There is a data which says 97% people stop their SIPs in first 5 years. And let me give you a hack. Okay, suppose somebody is 24. If that person is investing 50,000 rupees a month and earning 12% return, which is a very reasonable expectation from a mutual fund, in 26 years, that person will achieve 10 crores. 50,000 per month, earning 12%, in 26 years, you will hit the 10 crore mark. So, which means by the time you are 50, you have hit the 10 crore mark. Now look at the very interesting stuff. The first 1 crore will come after 10 years. So at 24 you started, at 34 you will hit the first 1 crore. This is the most difficult part of the journey.
Yeah.
97% of these people would have stopped their journey in the first 10 years. The first 1 crore is the most difficult to make, which will take 10 years. From 1 crore to 2nd crore, it will take only 4 years. And then 2nd crore to 3rd crore will take 3 years. And the most fascinating part of this journey is that the last 1 crore, from 9 crore to 10 crore, will take 10 months only.
Wow, under a year.
Under a year. 10 years, first 1 crore, last 1 crore under a year.
Yeah.
Right? This is what most people miss out.
Yeah.
So you have, the most difficult part is the initial part, 5-10 years. Because once you have understood how this game works, then you will stay there. Then you will not have the urge to withdraw. That's important.
And what about the right mix when it comes to mutual fund investing? Because there's so many types. There's hybrid funds, debt, equity. What do you suggest or advise should be the right mix in the different types of funds?
So this would be quite personal because it depends on what your goals are, what your requirements are. You have certain requirements after 2 years coming, certain requirements after 5 years. So I generally say if your requirements are less than 3 years, try to have a very, very safe portfolio for those.
What's a safe portfolio, if you could break it down in terms of
suppose you want to buy a car in a year's time, right? And you have saved X amount of money. So I would say invest put in a debt fund.
How much percent would you say in a debt?
Almost all the money for that 1 year goal should be in debt fund. Okay. Because you know that in 1 year this goal will be coming.
That is for that goal you're saying is a debt fund.
Yes.
Okay, got it.
If the goal is in 3 years, I want to take a Europe vacation. I need 10 lakhs corpus. Again, I would say bulk of the money should be in debt fund, 80-90%. Maybe 10-20% of the money you can keep in hybrid funds, where you want little better returns. But if the goal is like, let's say 10 years down the line, children's education, right? Then nothing should be in debt at this point of time. It should be mostly in equities. Or if you are very risk averse, then have a mix which is hybrid funds, right? And one thing also you have to understand, suppose you are investing for your children's education and you need 2 crores. You are doing your SIP. Suppose in the 8th or 9th year, that corpus has now become 1.8 crores. You are very nearing your goal, very much, right? And start gliding down the risk. Move from a pure equity portfolio or a hybrid portfolio to a debt fund portfolio. So that when you are nearing the goal, you don't have to worry about the market fall or crash because you have already saved. It's just like that aeroplane, when it wants to land in Bombay, it starts gliding down from Pune. It starts coming down, of the altitude. So that's what you have to do with your portfolio as well.
Okay. And give us a sense as to how often should one review their portfolio or go over it, and what should they know about when they should make those changes required?
See, I think once in 6 months is a good idea. Just to review, it doesn't take more than 15-20 minutes, right? You might not do anything with the portfolio. See, reviewing doesn't mean that you have to do action.
Changes, yeah.
Okay. In investing, more so in mutual funds, look, your fund manager is anyway 24/7 working for you. He's already watching your portfolio, right? Secondly, if you have an advisor, even that advisor is also working for you. So then why you have to really get involved, right? So maybe once in 6 months or 12 months, you may review, not from how your funds are doing and stuff, but more from your goals perspective. Has your life circumstances changed? Did you get a raise, or did you got fired, or something happened with your life goals, right? 90% of the time I say don't touch your funds. This is what most people don't know. With my portfolio one in the last 15 years, 95% of the time I've not done anything. In fact, there were few funds in my portfolio for 10 years I made zero return. There were funds in my portfolio after 10 years I was sitting on 0% return, because I knew someday it will come to 15% compounded. I don't know when.
Yeah.
And today, after 14 years, I'm getting 15% compounded return.
Okay.
Because I had that kind of confidence. But I've seen a lot of people, when they see the funds, 6 months it didn't perform, 1 year, they will check out.
Yeah. More than confidence, it was patience also.
It is patience.
Yeah.
It is patience.
Yeah. And, then there's a classic example since the pandemic. For example, mutual fund house like a Quant mutual fund made those extra normal returns that we saw, and everyone wanted to cash in on that opportunity. But then there was a reality check over the last 6 months. Tell us more.
Howard Marks, the legendary market guru, has 2 rules of markets. Number 1 rule is markets are always cyclical, right? Everything in markets will have a cycle. Second, markets are always volatile. Last 4 years, both these rules have been broken. Markets are not cyclical. Markets are always going one way up.
Yeah.
Second, markets are not volatile at all. Every day, every week, we just see 2% fall and it again comes back to normal. We have not seen 5, 10, 15, 20% fall. But someday it will happen. We don't know when. So right now, in the last 4 years, you just give an example of Quant. Quant has done exceptional performance in the last 4 years since pandemic. Before pandemic, nobody knew about Quant, right? Today, everybody is aware about Quant, because all the schemes were chart toppers. If their fund has given 50% return, the second best fund was giving 25% return. Huge difference.
Yeah.
And now today, with the power of social media, everybody knows, you can see on your app. So most retail investors chase performance. This is the worst thing you can be doing by investing in a mutual fund, because you are seeing a performance which you never got. Somebody else got, right? But you think that this will be repeated in the future. See, unfortunately, mutual fund, has a disclaimer. Mutual fund are subject to market risk. Past performance may not be repeated in the future. All mutual fund houses publish this line. Nobody takes it seriously.
Yeah.
In fact, they take it the other way seriously, that past performance will be repeated in the future. Any retail investor's portfolio, they will be loaded with funds in Quant, small cap, mid cap. As I said, markets are always cyclical. The good fund house or the best performing fund will never remain the best performing fund. It will come down. It is natural. Today, all the schemes of Quant are at the bottom of the charts on the last 6 months basis. Imagine a lot of retail investors have put good amount of money in these funds. And you know what they'll be doing? They'll be leaving out they'll be just kind of coming out from this one in the next 6 months or 12 months time, because they are seeing negative returns or very poor performing returns. In fact, I always tell, when the fund is doing bad over a 3-year period, that's a time to put money in an underperforming fund. And when the fund has done very well compared to benchmark, compared to others, that's a time to get out.
Yeah.
Because what will happen? Once any fund which does the best performance, a lot of money will come at the top, right? And then it is very difficult for the fund manager to repeat that kind of performance for the new money. So wise investor will sell when there's a lot of gush in the inflows, and he will buy when nobody's looking at that fund. So in last 3 years, all those funds which are following value style, right? They are at the top right now. The quality companies or quality banks, they were out of the favor. Someone like me who has spent 20 years in the markets, I would like to go contra.
Yeah.
I would like to buy those funds which are underperforming, which are right at the bottom of the heap, because I know why they haven't done well. And as I said, markets have cycles. In the next cycle, when quality does well, I'll be making a lot of money. So don't chase performance.
Yeah.
In fact, Morningstar and all others have studies that the funds which were top in the last cycle end up becoming the bottom performing fund in the next cycle.
Yeah.
And that is why most of the time retail investors end up losing money, don't create wealth.
Yeah. Speaking of mistakes, you spoke about some tough times that you went through when you lost, your money. What have been some of the other instances? How did you come out of those tough periods in your investment journey and say, this is worthwhile and I want to stick to this decision to compound my wealth?
I'll give you a very good, nice hack. Okay, 2 things. First, if you want your 100 to become 200, day 1, be prepared to see 80 first. At your portfolio level. If you're not able to see 80, you'll never be able to see 200 in your portfolio.
Yeah.
Okay, just have that mindset. Though you're investing $100, be prepared that someday it will come to 80 first.
Yeah.
Okay, that's the first thing. Second, why most people are unhappy or very happy? Most people are unhappy because the reason of unhappiness is what expectations you have set and what is the reality. The difference between expectations and reality is your level of happiness or unhappiness. Suppose your expectations were 12% and you end up getting 15%, you'll be very happy.
Yeah.
But if your expectations were 18% and if you still get 17%, you will not be happy. That's what's happening in markets today. Today, people are expecting 18%, 20% returns based on the last 4 years. So even if they are getting 15%, they are not going to be happy. So if you want to create a lot of wealth in the markets, set your expectations low. So my expectation with my money was always around 15%, let's say. But to the viewers, I would say, if you're investing in equity funds for a 10-year period, set your expectations as 12%. Because that's been the long-term range of markets. Why I said 15% for myself, one, because I've been an experienced investor for the last 20 years. Most of my money has been in mid and small caps because I understand the risk, I understand the volatility, right? That is why 15% I'm reasonably confident I can achieve, but it is very difficult for normal people. So set your expectations as 12%. Anything that you earn above 12% over a 5-10 year period is all bonus.
Yeah.
If you have this mindset, you most likely you are not going to make those big fatal mistakes. Right? You'll be very happy also. You'll get a good night of sleep. And this is a reasonable level of performance you can expect from the mutual funds.
What are the common behavioral mistakes that people make when it comes to managing their money?
The first is, as I said, greed and fear cycle.
Okay.
We become too fearful when we see panic, the first sight of panic, and we become too greedy. So we move in extremes, always move in extremes, right? You should be doing the reverse.
Yeah.
Right? That's the first thing. Secondly, people do not have patience these days. As I said, the FOMO factor. With my money, I don't even bother. So, I don't even bother to leave, even if it is 20%. In fact, I've trained my mind in such an extent. So today, when markets are going high, I'm actually very unhappy. While my portfolio is showing 18-20% compounded return, I'm not happy.
Yeah.
Because Warren Buffett says that if in the next 5 years, you're going to put loads, you're going to put tons of money in the market, do you want the markets to go up or go down?
Yeah.
Right now, every month, my SIPs keep buying at the higher level. I'm not happy. I want markets to go down because I'm going to put a lot of money in the next 5 years. When do I want the markets to go up? The day I start needing money back. That is the time I want markets to go all-time high so that I get the best of, my corpus. So you have to train your mind in such a way that when you're doing SIPs, you are collecting units. Now, I want to ask you a question, Avan. In what time periods you collect maximum amount of units? When the markets are at the low, right? You will collect more units. You should become a collector of units.
Buy those Gucci bags, those stocks.
Absolutely, yeah.
Yeah.
So while you're buying more Gucci bags when there is a sale, buy more units when there is a sale in the mutual fund.
Yeah. But what's the argument that you would give people? Because it's a debate I have with my friends, etc. a lot of the times. So when they say direct equities, you should be investing there. I've made X, I've made Y. It's held me in good stead for a long period of time. Now, assuming someone doesn't have enough time to devote to it, I mean, they have their own other things, the experience is not there. What is your argument that mutual funds should be the better way?
See, one lesson I've learned in my life, you don't need to know everything in the world. But you need to know for which work, who is the best person.
Yeah.
Right? I'm a CFA chart holder, MBA finance, been in Mumbai for last 20 years, been in and around markets, have a great network. Still, I don't put a single money in direct stocks. I have access to all the fund managers, everyone, right? Because I've realized that if I don't have time, I might have the knowledge, but if I don't have time, and when I say time, it's a full-time activity.
Yeah.
Investing is a full-time activity in the sense you have to read a lot of balance sheets. You have to understand the sectors, companies, economy. It's too much, right? So if I don't have time,
but you have access to people who are telling you, like you can get a tip, for example, or
look,
ye khareed lena.
Wealth can never be made on borrowed ideas. I may borrow idea from you, but I cannot borrow conviction from you. Conviction will only come if I have invested my time and effort in finding out, doing that research.
And you're not going to go knocking on their door when that investment tanks, right?
That's again,
Yeah.
right? So every time I can't go, arey, upar gaya, niche gaya, what should I do, right?
Yeah.
So I need to have conviction. And wealth can only be created by conviction, right? See, because I had conviction that this fund will give me 15% CAGR, I could wait for 10 years when it was showing 0%. I had the conviction. Today, that fund is giving me 15%. I know it will give me 18%. I'm very sure. Again, I don't know when. I may have to wait for another 5 years. That's conviction speaking. Okay. So to most retail investors, I give them an open challenge. I say, look, my last 15 years, my portfolio has given around 18% CAGR right now. Of course, markets are high. That's why it's 18%. I say, if in your stock portfolio, if you're given more than 18% CAGR over the last 15 years, I'm willing to hand you my entire corpus.
You've done that challenge with people?
I've done that challenge with anyone. Show me your numbers, real data for 15-year period on a large corpus.
Yeah.
And if that beats my mutual fund return,
no one's ever gotten your corpus.
No one. So far not. No, it's difficult. See, last 3 years were different.
Yeah.
15 years is a marathon. It's different.
Yes.
Right? You have to ride the entire cycle. That is why investing is never easy.
You know, Gajendra, but when it comes to choosing the mutual funds, I think everyone would adopt that method. I went on Google. What are the top 5 funds I should invest in? What is the biggest mistake in doing that?
Absolutely. So, we've been doing a lot of podcasts and thousands of viewers have reached out to me and saying that, can you suggest me 3 best funds where you have invested your money? I said, look, if that was so easy, then, none of us have to be watching these podcasts, right? You would have all been making a lot of money. I want to ask you a question. You follow cricket?
A bit, yeah.
A bit, okay. You fan of Sachin Tendulkar?
Yeah.
Of course, all of
Who
us,
isn't?
right? Yeah. Now, if I give you
ask me some cricket stats.
No. I'm going to make your life easier.
Oh.
If I'm going to give you bat of Sachin Tendulkar, from which he has made amazing knocks, right? Would you be able to make a century, from that bat?
Absolutely not.
Right? You can't.
Yeah.
You have to become Sachin Tendulkar. You can't hit a century with his bat. You have to become like him.
Yeah.
Same thing, even if I give you the best performing funds, you won't be able to create wealth with that. You have to become a good investor.
Yeah.
And that is where temperament is necessary.
Yeah.
That is where learning, knowing yourself, knowing the mistakes that you have and correcting those is necessary. You need to have an advisor. See, even Sachin Tendulkar needs a coach. Right?
Yeah.
Indian national team needs a coach.
Yeah.
When you play gully cricket, you don't need a coach. When the stakes are high, you need someone to advise you. You can't afford to do big mistakes, right?
Yeah.
See, when you're investing 5,000-10,000 SIP, even if you make mistake, it's okay.
Yeah.
But if you have a 5 crore portfolio, one mistake you do, you go back by 3-4 years.
Yeah.
Right? So you need a coach, you need a guidance.
And then, Gajendra, just to get right back and scratch that point about thematic, sectoral, majority of money as well has gone into, in terms of inflows, has gone into small cap funds. That can be a dangerous game to play as well, right?
Yeah. As I explained earlier, it's all cycle of, fear and greed. People at this stage are very greedy. They think it's easy to make money, and sectoral funds, small cap funds are the fastest way to create wealth. Yesterday, I got a portfolio to review. Young person, 4 crore portfolio, having 20 small cap funds only in the portfolio. Only small cap funds, 20 of them. My first thing was that, okay, I understand you are a very aggressive investor, but then why 20 funds? You would have just invested in one small cap index fund and you would have been doing equally well, right?
Yeah.
But they think they are diversified if they're investing in 20 small cap. It's not diversification. You're taking the same risk with the same, set of 20 funds. So I think because people are extrapolating what happened in the last 3 years and they think it is going to continue, See, one thing you have to understand, when you are going into sectoral, thematic, small cap funds, your timing has to be perfect. And when I say timing, your entry and exit both have to be right. Right? What time you entered, you have to enter right at the bottom or near bottom, and you have to exit right at the top. Right now, it's the reverse way happening. People are entering more at the top, and as history has shown us in the last 100 years, they are going to exit at the bottom, and they're going to lose tons of money in this. I can see that.
Yeah.
Because I've experienced this 20 years, right? So for most retail investors, sectoral, thematic, mid cap, small cap is a complete no-go zone. Even if you want to play in that 30% satellite portfolio, not with the core portfolio. Core portfolio has to be flexi cap funds, diversified equity funds, those funds which you don't even want to look for 10 years, right? And they will be more consistent. And somewhere we discussed that, look, we are all talking about long term, 20 years. 20 years, all of these funds create wealth. But long terms is nothing but series of short terms, series of 20 one year periods, right? You have to survive those 1 year periods.
Yeah.
What if you don't survive in the first place? What if you check out after 2 years when you're seeing negative returns? Then forget, there's no one at the long term right end. So if you have to survive these short terms, you have to make sure that you have consistent returns in your portfolio. Small and mid cap sectorals will give you very volatile returns, which you'll not be able to withstand, right? That is why core portfolio 70%, stay in large cap, index funds, or a flexi cap fund. 30%, I may understand, but with those 30% portfolio, also take in professional help, because timing is going to be very critical when you want to make money in small cap or sectoral funds. It's not as easy as it sounds.
Gajendra, what about the issue when it comes to over-investing? Because 67% of the money that's being deployed is in the Nifty 50 companies across mutual funds. Do you think that index investing should be the way to go?
Absolutely. In fact, if today the most temperament problem comes because you have 2,000 mutual funds schemes, and there's a lot of choices around you, and you get, you get confused, right? And that is why you're chasing hot performing. The simplest solution was actually index fund, for which, this would have solved all the problem of active funds, right? So if you choose index fund, as you rightly said, 67%, anyway, all these active funds are putting money in index funds. As an investor, if you choose index fund, 90% of this temperament problem will go away anyways, because you are putting all your money in a simple index fund, which is tracking the index. You are buying the index, or you're buying the stock market. And then you don't ever have to worry about underperformance or outperformance, because you are buying the entire market. So for 90% of the investors, index fund remains the best choice if they are doing on their own. Of course, if they're taking professional help, and then, the advisor is helping them on selecting the right kind of mutual fund based on the research and, the valuations, then it's a different story. But otherwise, on your own, when you're doing DIY, index fund is the best vehicle for you to go forward.
Gajendra, you've really opened my eyes for sure, and I'm sure everyone who is listening, as to how important and critical behavior plays a role when it comes to managing money. Thank you for taking the time out.
Thank you, Avan. It was a pleasure doing this show with you.
So just to sum it up, some key takeaways. Number one, investments is a long-term game, so you need to have the patience. Number two, markets are cyclical. Cycles are very important, so it is not always going to be a one-way trajectory, and you need to keep that in mind. Number three, psychology and your temperament plays a big role when it comes to investing. And finally, having a qualified financial advisor is critical. And as Gajendra said, the best time to start is now. I hope you enjoyed watching this episode. If you do remember to subscribe, and we'll catch you in the next episode. Thanks for watching.